Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always as Hormuz Patakia and Reema Tendulkar. Hey guys, happy Friday to the two of you. And looks like Christmas has come early. Look at our color coordination this day, and definitely the color of today is red. Markets would have wanted some green, especially after that recovery that we saw yesterday. But most of the gains that we saw yesterday from the lows, they have been given up. So Nifty right now down around 170 points as we speak. We have the mid caps which are underperforming with a cut of around 1%, and all the sectoral indices, they are in the red right now. The biggest loser being the metal index, followed by realty, and realty has been an underperformer for a long time. Despite that status quo that came in from the RBI, maybe the expectation was there could be a cut which could spur more housing demand. But for now, Nifty Media, which was the sole index in the green, that has also come off sharply from the highs of the day. So definitely a red-looking screen today. A lot of moving parts in terms of broader market movers, especially because of the earnings. But we are towards the fag end of the earnings season now, guys.
And it's been a tough week, right? Like barring the Monday pop and yesterday's little bit of an intraday recovery, markets have been largely grinding lower. From here on, one level to watch will be yesterday's intraday low, 24,344. That was the intraday low from which the market staged a remarkable recovery. So that level we need to see if it sustains. Also, just the market mood is that even where the numbers were fairly decent, good numbers, stocks are getting punished on the way down. So look at a Kalyan Jewelers. Numbers were fine, 30% plus revenue growth, 18% same-store sales growth. Stock is down 7-8%. BSC is another one. Good numbers, but the stock is a bit subdued in trade. And that just tells you the kind of market mood and sentiment that we're currently in. That said, there are two big earnings that we're expecting today. State Bank of India, that comes in market hours, and the other one is Tata Motors, that will be post. Grasim is also there, and a whole host of mid-cap companies. But we'll wait by for State Bank of India to set the tone in the second half.
The stock is already lower right now. Both of them actually at the day's low, but that's what the market mood has been, right? And we've been talking about earnings. There are a lot more other stocks which are on our radar. In fact, Hormuz has gone ahead to the big wall. He's here with us to put the spotlight on the top movers in the market currently. Hormuz, tell us more.
Well, and shades of red, so I'll start out with some green and how as well, right? NSDL, the recent listing, 3 days of listing, and the stock has already popped 60% now from its IPO price, which was around 800 rupees. The stock is now at 1300, 15% higher today as well, following yesterday's 20% move and the listing day pop of 17% from its issue price. We've already had 2.5 crore shares already traded in the first couple of hours of the trading session, compared to 5.1 crore yesterday and around about 3.75 crore on the listing day as well. And because of these 3 days, NSDL, which was earlier at a valuation discount to its peer CDSL, now trades at a premium compared to CDSL. On the downside though, an earnings reaction, data patterns is the 4th straight day of losses for the stock. Another 8% knocked off today, and now 12% lower in 4 trading sessions on very heavy volumes as well. Close to 5 lakh shares have already been traded compared to a 20-day average of just around 85,000 shares. Another earnings reaction, Talbros Automotive, and after this 6.5%, almost 7% now, the stock has now broken below its 100-day moving average on the downside. It's now declined in 3 out of the last 4 trading sessions. And look at the volumes here. Already we have had over 1.5 lakh shares that have traded compared to a 20-day average of just 20,000 shares. And because of this down move that we have seen recently, the stock has also turned negative on a year-to-date basis. But on the flip side, a stock that is bucking the trend is KRBL, and it snapped a 3-day losing streak today at a time when most of the indices are at the lows of the day. KRBL is up 10%. And look at the volumes here as well. We have had close to 65 lakh shares that have traded already compared to a 20-day average of just 3 lakh shares. And in 2025 already the stock is up almost 40%, and this comes on the back of 2 negative years that the stock has had. So there are stocks that are bucking the trend, but the overall mood of the market though remains on the downside.
Oh yes, it does. That's what we can see in the mid-cap and small-cap index as well. Thank you so much, Hormuz, for joining us with all those details. It's time actually to slip into a break. Up next, we'll put focus on the crypto market with Manisha Gupta on the other side. Stay tuned for that.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. As promised, we'll shift focus now to the crypto markets. Manisha is here with the latest and some developments for the 401k on crypto, Manisha.
Oh, well, absolutely. Never a dull day here. But as we start our new segment here, and it comes on a positive and a higher note as well, because the U.S. president overnight has signed a very important bill. This is the 401k retirement plan. Until now, the investments could only be done in case of stocks, bonds and cash. But now the 401k funds can be put in real estate, private equity and, yes, in cryptos as well. While, of course, this comes in as a very, very strong positive, the order also directs the Department of Labor to actually look into this as well on how and reevaluate as well on how crypto should be treated by retirement fund managers going forward from here. Well, interestingly, this could lead to crypto integration with broader financial system, bring it mainstream, and that is exactly something that the US has been working on for some time. Though there are experts and commentators expressing concern as well about higher degree risk and volatility that cryptos also brings on the table there. Interestingly, when you look at the last 1 year, we've seen a lot of positive, friendly regulations coming in US. The Bitcoin ETF is a success story that was launched in January 2024, and we've seen billions of dollars or inflows coming in for the Bitcoin ETF. And then it also has been about US, where we've seen the Genius Act go through. Clarity Act and Anti-CBDC Surveillance Act are a couple of acts that the US president perhaps could be signing in days to come. Genius is already on there. And then apart from that, it also has to do with a very strong June quarter that we saw. It perhaps has been the best on record. Remember, Bitcoin hit record highs in the month of April there, and it has been holding above that $110,000 there. Bitcoin volatility also is at its lowest since 2023, indicating that there is a maturing market. Remember, the adoption also comes in from corporates, companies, institutions, etc. And that has been giving much needed credibility to the crypto markets as well. Apart from that, when you look at the overall market capital, that has been on a rise too. $3.95 trillion at the last count. It did touch $4 trillion as well in the previous week itself. The final plate on the screen should come in on your screens that tells you on how the cryptocurrencies really have performed in this year and in the previous 12 months as well. So Bitcoin has given you 92% of returns in the last 1 year, and we've seen very strong gains, anywhere between 50% to 500% of gains. That is what Ripple really brought to the table as well. So many of these are second layer, first layer cryptocurrencies. These are the tokens that actually have established their credibility, are long-term investments, and that's the kind of gains that they have brought onto the table.
Whoa, look at the returns. A literal ripple effect, if we can say that, on the other cryptocurrencies as well. Thank you so much, Manisha, for always bringing these nuggets and interesting updates when it comes to the world of cryptocurrencies as well. That's about the crypto world. Let's get back to the equity world. Century Plyboards, that's the stock on our radar, reported a good revenue and EBITDA growth in its Q1 earnings. Keshav Bhajanga, the executive director of the company, is joining us now to take a few questions. Keshav, good morning. Thank you so much for joining in. You have given us a guidance update for different segments. So let's drill it down further. Let's talk about how the prices of timber and chemicals are currently compared to last year. What is the outlook going forward? Because your margins have been flattish on a YY basis if we talk about a consolidated level. What is the overall margin expectations when it comes to FY26 and FY27?
Good morning. Thank you so much for having me on the show. I think with regards to the expansion in EBITDA margins that you're talking about, if we look at EBITDA without Forex, it has actually gone up by about 29%. So it is quite a big delta. But as you know, the euro and other currencies have shot up. So because of that, EBITDA post Forex doesn't seem to have much of a change. Having said that, in terms of raw material prices, timber prices as far as MDF and particle board have certainly eased up slightly. I think the peak or the highest raw material prices are now behind us. So going forward, I think this should aid margins in the sector. As far as chemical prices are, they are pretty much stable. There isn't a very big delta. There are small changes that keep happening, as is usual with commodities. But I think in terms of margin guidance, what we had committed, 12 to 14% for plywood, high single digit for laminate, 15% for MDF, and steady state 15% for particle board once the new plant ramps up. I think we're well on line to achieve the same.
Okay, so the margin guidance across all segments remains the same. Even your sales growth, 10% plywood, laminates 20%, MDF 20%, particle board 40%. Keshav, these numbers also, you maintain them, this guidance?
Yes, definitely. I think, considering the overall slightly bearish scenario in the industry, our overall growth of 16% on a console basis has been healthy, and we have exceeded the guidance given across segments. Plywood has had a revenue growth of about 15%. MDF has had a revenue growth of 23%. So the miss has been predominantly on account of particle board because the new capacity has not come in. And in laminates, where the execution, finally we are seeing improvements on ground, but the scale up is taking slight amount of time.
So on laminates, do you maintain your 20% consolidated guidance? And on particle boards, the 40% sales growth, considering in Q1 there was a decline?
Yes, definitely. Particle board, the new capacity is actually a 800 cubic meter plant, and our earlier capacity was only 250 cubic meters. So the plant in itself is more than 3x the earlier capacity, and we were hamstrung by capacity. So I think particle board will not be a challenge in laminate.
So what is the capacity utilization on the new plant? Sorry to interrupt. And what would be the incremental revenue?
The new plant, as of now, has just began operations. 27th of June was actually the date of commissioning for the new plant. At peak revenue, the new plant should have a 500 crore plus turnover potential.
Keshav, how has pricing been so far? What about timber and chemical prices? Timber prices have remained at slightly elevated levels. Have they seen some moderation? And if not, are there any plans to pass on those elevated costs to your consumers?
I think I just mentioned slightly earlier that timber prices have moved past peak. They have cooled off slightly, and I think the highest or the peak of timber prices is behind us. Chemical prices are more or less consistent, so I don't think there's too much of a need to increase prices at this point in time. But it's a wait and watch scenario. Going forward, we will see, and we'll play it by how demand and raw material prices pan out.
Got it. Keshav, you do have capacity utilization which is coming in from new plants. Any other capex plans that you have in place? What would the balance sheet look like in that case? What's the updated debt right now?
Currently, our only frozen capex, large frozen capex, is the new plywood plant in Hoshiarpur. That plant will have a capex of anywhere close to 100 to 150 crore rupees, and it is likely to come up within H1 of next year. So that is the only large capex that we have planned. We have nothing substantial that has been approved by the board yet. Yes, there are discussions for other expansions, but nothing has been frozen yet. Having said that, with regards to debt, I think our long-term debt is within 800 crore rupees. And going forward, the objective is that we will deleverage the balance sheet over the course of the next few quarters. As you can see, our cash generation is quite strong, and profitability continues to improve. So I think within the next year and a half, our objective will be to get back to practically zero debt levels.
So from 800 crore, you're saying you will be a zero debt company in the next 1.5 years, purely led by internal cash generation and accruals, not some external. Got it. Thank you very much, Keshav, for joining in. Always a pleasure chatting with you. Get into a break. On the other side, Sheshadri Sen of MK Global will join in, and he's going to give his view and perspective on how investors can weather the current turbulence that we're currently seeing. Welcome back. Since morning, we've been talking about the sharp decline in Coforge. Just pull up that intraday chart of Coforge, and I think the stock was down about 4-5%. And if you pull up a one-week chart, I think for the last 2 days, stock has been a bit subdued in trade. Well, one factor is that Sabre. Remember, the company had won a large $1.5 billion deal from Sabre. It's a travel and tourism company. It's listed on NASDAQ. They have slashed their guidance. So they came out with numbers yesterday, and on NASDAQ, Sabre ended with a cut of 35%. And they're now talking about revenue growth guidance, which was in mid to high single digits, has been brought down to flat to low single digits. So stock was under pressure, Sabre, They've slashed the revenue guidance, and for Coforge, Sabre is one of their large clients, and I think that explains why the stock is under pressure. But as promised, let's talk about markets, where we are headed, and how do we navigate the turbulence, the tariff turbulence that we're seeing. Seshadri Sen from MK Global joins in with his thoughts and perspective. Mr. Sen, always a pleasure chatting with you. This is Rima here. Open-ended question. You've had 48 hours to think about this. What is your advice now? 25 plus 25 as we stand now.
Hi, thank you for hosting me on the show. In the short term, my short and sweet advice is do as little as possible. Do not try to trade this this news flow because you can get whipsawed in either direction very, very badly. Things could turn on a dime. There are multiple cross currents which could take this the tariff story in either direction. Over the longer term, yes, this is incrementally a negative for India, and there is a potential for some level of derating. But I don't think that this really impacts the longer term story. From a 6-month plus perspective, we continue to be constructive on India as a market, and would additionally, because of this uncertainty, focus much more on domestic facing sectors. Be very careful of investing in globally exposed sectors, not just because of the tariff regime that has come in, but because once all the tariffs settle down, we are expecting a sharp global economic slowdown. So tariff or no tariff, I think it is time to be a little careful about export-oriented and global-facing sectors. As far as the domestic sectors are concerned, the primary driver of that is the aggressive monetary easing by the RBI. I know there was a little disappointment that they did not cut earlier this week, but that's not a problem because they've done enough so far, in our opinion, to trigger a cyclical consumption recovery in the second half of this financial year. It just will take a little more time to percolate through, and we expect sharp improvement in retail credit offtake, driving discretionary consumption. So our focus remains on domestic-oriented sectors like the consumer discretionary and to some extent industrials.
Got it. Seshadri, you are saying even if there were no tariffs, it is not the time to look at markets from a fresh buy perspective. At what level would you be comfortable? How much more does the market have to fall for you to be comfortable in terms of valuations for a fresh buy?
So there are two scenarios here. One, if the market corrects by more than 5% from here, I think that's a time to aggressively re-enter the market, with the caveat that I said earlier, focus on domestic-oriented sectors. Or give it a little time. Let's get closer to the festival season. By then, there will be clarity one way or another of how the trade scenario and the tariff scenario works out. And that time, selectively start nibbling again at domestic-oriented sectors.
So, Seshadri, you mentioned if there is a 5% decline, you can aggressively enter. But do you see that potential of a 5% decline? Of course, 5% in a market like this, in a scenario like this, may not be too much. But do you see such a potential to happen?
First of all, no, I don't think 5% is small. 5% correction in the broader market would mean that, in the smaller cap universes, you'll see many stocks correct 15 to 20%. So 5% in the Nifty could be a fairly major correction. It's not in our base case. We don't see that happening. All the bad news is already in. How much worse can it get in terms of a scenario? The only way that could happen if there is a sudden sell-off in the rupee, and that would trigger FPI selling, and it could potentially bring the market down. But we've also seen the domestic flows, especially with falling interest rates, will remain robust. So no, not in our base case. It's just a what-if scenario. If you do get more than a 5% correction, that's the time to buy. But most likely is that the markets will time correct from here for the next 3 to 6 months.
Okay, 3 to 6 months time correction, or we could see at best a 5% correction, which would be a time to buy. Why are you so confident that, in the second half of the year, the domestic story is going to stay intact? And secondly, do you expect any sort of, relief coming in from the government? I mean, there is some chatter that on the 15th of August, we will hear something by way of reforms, which have sort of been absent. Are you in that camp? Is that something which we need to revitalize domestic growth?
Let's answer the second question first. I don't think structural reform can be switched on and off. There have been plenty of forward movement on many areas. Maybe some of these could see some acceleration. More likely, if the final tariff scenario does turn out to be very adverse for India, the government may be forced to accelerate a stimulus. Historically, the government has been unwilling to give a large fiscal stimulus. The preferred route is monetary stimulus, and therefore that may get accelerated. But yes, a response to this, in the immediate response to this, is more likely to be a stimulus rather than accelerated reform, because reform takes time. That's not to say that there isn't a case for accelerating reform in many areas and pushing that through, but that's not an immediate solution to the shock that the economy faces because of the higher tariffs.
Okay. So, Seshadri, while we are talking about reforms, domestic facing sectors, of course, have seen a positive impact of that, be it some of the sectors like defense as well, and the ones that you mentioned because of higher domestic demand. What are some of the sectors you're not bullish on? Maybe because of valuations, maybe because of demand concerns, or maybe because there are no fresh triggers from here on for them?
Financials and technology are two sectors that we are underweight on. Technology, first of all, technology, you have to trade the multiples. It is the only time you make money in technology in the post-COVID world is when you have valuations on your side. We still don't, when it goes to say -1 standard deviation, that is a good time to look at technology. So one such opportunity presented itself on the day of the Trump pause. The other sector is financials. Large banks, we think, are growth challenged, and valuations do not reflect that. In the shorter term, they are facing margin pressures, which is further, affecting their revenue growth. So we've been structurally underweight on lending financials for quite some time. We remain so. We would look at that sector only in a selective stock picking basis and not as a broad brush overweight on the sector.
Seshadri, pleasure having you as always. Thank you so much for sparing time and joining us today with your views on what next for the Indian markets after Donald Trump's tariff tantrum. We'll take a short break here, but just before we do that, remember to tune in to the all-new CNBC TV18 Prime, which brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 this evening.
Welcome back. You're still tuned into Trading Hour. It's a good time to get the latest trends from the F&O space. Mangalam is joining us now with just that. Mangalam.
Well, as we can all see, the market's been grinding lower. Yesterday, the last hour, there was a big uptake. A large part of that was on account of expiry-related short covering. And now it was only fair that, once that move was taken out in the morning, first thing that would be unwound, and that's exactly what took place. So you have the Nifty bankers, the mid-cap index, all of them lower. In the last hour, we also saw yesterday the volatility index saw a big nosedive, and now this morning it's come up back again closer to the 12 mark. So that's something which the street is pertaining as or looking at as sustainable from here on. The two data points that I'll be watching out for: one, the advance decline ratio. We have more stocks declining than the number of stocks which are advancing. Does that widen? Does that ratio widen from here on or not? And the second part I will look at is, does Nifty breach today's low and close to yesterday's low as well? Yesterday's low on the Nifty was 24,344. Today's low 24,408. So that's something we will watch out for very, very closely. And remember, on the way up, you have to keep an eye out on the 100-day moving average for the Nifty. Yesterday it closed above that, but the 100-day moving average is moving higher, right? So 24,474 mark is something that we need to conquer on a closing basis for the frontline index. Call writers believe that maybe on the way up there is congestion. That's why the 24,500 call and the 24,600 call writers, these are options that expire next Thursday. Fairly active in trade, 100 rupees premium on the 24,500 call and around 60-70 rupees on the 24,600 call. So around 24,600 to 24,650, there is supply which is likely. But at the lower levels, bulls aren't throwing in their towel. The 24,400 put is fairly, active in today's trading session, along with the 24,450 put. That tells you that closer to yesterday's low, around 24,300 to 24,350, there is likely to be some support for the frontline index. But a couple of stocks that deserve mention. Bharti, Airtel, after the large trade, a lot of open interest activity taking place out there, most of that understandably on the short side. But the other one that we're looking at is Kalyan Jewellers, a huge jump in open interest, and the stock has seen a big nosedive from the top. Currently seeing a lot of short build-up, so watch out for Kalyan Jewellers. And finally, yesterday we had pointed out the possibility of RBL Bank looking to cross the threshold after which it will enter F&O ban. It has happened in the first hour of trade itself, so won't be surprised if RBL Bank does go into F&O ban today post-market.
RBL Bank may enter the F&O ban. Mangalam, thank you for that update. The market still remains 160 points lower, and by the looks of it, this could possibly be the 6th straight weekly loss for the index. The level at which the Nifty needs to close above is 24,565 for a weekly gain, and in case that does not happen, this will be the 6th straight weekly loss for the Nifty. And in case it is the 6th straight weekly loss, the last instance of this happening was back in February and March of 2020. Mitesh Thakkar now joins in for a quick chart check. Mitesh, what are the levels that you are looking at? Do you see a retest of yesterday's lows, or do you expect the index to consolidate at these levels? And of course, your stock recommendations for the morning.
So, good morning. I think, very clearly, the Nifty has once again started trading below 24,550. But what is important is that, if you look back on the price action of Nifty in May, there was this big gap at 24,400 to about 24,200 zones. So I think we saw yesterday the market kind of make an intraday low there. That level should still come into play and bounce back should happen. But broadly, this market isn't a strong market or showing signs of reversal, which means that any rallies would be more of a bounce back in nature, and therefore, booking shorts around 24,400 may not be a bad idea. And trying to, see at high levels where we see supply re-emerge. I was hoping that we go to about 24,750 when yesterday the bounce back started, but then with the negative news, the gap down again happened. But as I said, closer to 24,400, try and take profits of short positions. And on the stock side, I have a buy on Fortis. That's a stock which is clearly shown outperformance and strength in this market. So buy here with the stop at about 884 for targets of 930, and a sell on Astral, which I would recommend selling with a stop just above levels of 1,405 and look for a target of 1,340.
Okay, all right. Thank you so much, Mitesh, for joining in with those individual stock names. But the big boy, State Bank of India, will report its Q1 earnings today. What are the key expectations? Gaurav is joining us with that.
Well, yes, when we talk about State Bank of India, now we are expecting 12% loan book growth in terms of a year-on-year basis. Now, remember, State Bank of India has the highest loan book, but even after that, State is expecting some kind of double-digit growth to continue. When it comes to deposit, 10% growth is what they are penciling in. And as a result, when we move ahead to net interest income, they are expecting around 1% growth on a year-on-year basis. And this is because of the cost of funds. Now, the pressure from cost of funds will remain. And as a result, net interest income is also likely to come down a bit on a sequential basis. When we talk about net interest margins, there also we may see a little bit of decline. When we move ahead to the operating profit, now treasury income is something which has been higher for the banks. We have seen it across the PSUs and even in the private sector banks, and that is the reason why the PPOP can actually grow at around 3% with some positive bias. When we look at the provisions, they will be a little high because Q1 is usually higher in terms of slippages for agri, and that is the reason why profit, now it is likely to decline by 2% on a year-on-year basis. There also we may see a little bit of positive bias because some amount of surprise can be seen in the operating expenses. So all in all, stable set of numbers is what we are expecting with good growth in terms of loan book for SBI in this quarter.
Gaurav, thank you for that update there. Keep an eye out on SBI. Numbers should be out anytime now, or 0.5% lower on the stock, and has been fairly quiet all through the year, and it hasn't moved a lot as well as SBI. Some life insurance data flashing on your screen as well for HDFC Life and for life insurance players. But we take a short break here, and just before we do that, a reminder for our viewers: unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, a premium member-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Now, in an exclusive conversation, my colleague Parikshit spoke to the management of Escorts Kubota on the company's capacity expansion plans and if the company faces any impact amidst US President Donald Trump's tariffs. Listen into a slice of that conversation.
We are at a very final stage of negotiations with the Uttar Pradesh government for our Greenfield project. And both Katusan and myself are very hopeful that we will have some kind of an announcement out. And therefore, the teams both in India and Japan are right now under discussion to create the layout and the capacity for our construction and our tractor and our agri-solution requirements for the immediate future and for the long-term future. As far as the current premises are concerned of Escorts Kubota at Faridabad, we are optimizing our capacity based on the need of the new products that are getting introduced. So, for example, I mentioned Pro Max. We are under extreme short supply because we didn't anticipate the demand and the excellent response that we've seen from the market. So we're optimizing on the capacity that is being created for both the domestic and some of the models that are heavily required on the export side. So I don't have any specific numbers to give you as of now, but as far as the capacity for the short and mid-term is concerned, we will adequately take care of that and ensure that we are able to address it adequately.
On the UP plant, there are reports which indicate delays. Could you give us a sense of the status of construction, land acquisition? What are the delays currently, if any?
So one thing I'd like to clarify that any delay that you talked about as for the Greenfield is concerned, firstly, let me reassure our stakeholders and our viewers that this delay is not going to affect in the growth that we envision because those capacity adjustments we have already done in our present premises at Faridabad. Your second question in terms of the timeline, we understand that the land under acquisition by the government of Uttar Pradesh is under final stages. We are now awaiting a confirmation from the UP government that once the land is fully acquired and we will do the due diligence, thereafter we will very, very quickly start the commissioning of what we would like to see come up in this new facility. Because the planning as for the new facility is concerned is happening between Japan and India already. So we will not waste time once we have the infrastructure and the acquisition part of it done with. So we will start immediately and we'll put up the plant in record time.
Right. Mr. Kato, if I were to ask you about what is the percentage of export revenue that is being routed to the Kubota network?
Thank you. Now our export revenue through Kubota network is around 70% of the total export. We have successfully utilized Kubota's sales channel to expand the sales, our export volume.
Right. I would also like to ask you about if you can give us any range in terms of export contribution to total revenue in 2 to 3 years.
Now, as I mentioned, we have expanding and we are going to expand the export sales. our plan is to expand 25% to 30% every year to increase the proportion of export volume.
Right. Also, if I were to ask you about the impact of tariffs on Escorts Kubota, what's the kind of tariff, what's the kind of impact you're envisaging, Mr. Kato?
Okay. Now, since our export volume or proportion is very low, so at this moment it is a not so big impact. And definitely, I believe, I think trade war is a threat, definitely, but I believe we don't need to consider short-term tariff fluctuations. It is uncertain and flexible. So our vision and our direction to expanding export sales by utilizing Kubota global channel, including the US and Canada, we don't need to change, I believe, in the long term.
The management there of Escorts Kubota. Take a short break. On the other side, get your excerpts from our exclusive conversation with the management of HUL to analyze the rationale behind the demerger for their ice creams business and a lot more. Stay tuned.
Welcome back. Let's get to an exclusive conversation now. HUL to demerge its ice cream business and the entity will be listed by this year. CNBC-TV18 Shilpa Ranipeta and Mangalam Malu spoke to HUL CFO Ritesh Tiwari about this and began by asking about the rationale and the details of the demerger.
Ice cream overall has a very distinct business model. It runs in cold chain in terms of manufacturing, distribution. It is prone to seasonality more compared to any other business that we have. It also has higher capital intensity compared to other business that we have. This is what makes ice cream very different to the rest of the business. At HUL, it has low synergies because of this very reason with all other categories that we end up doing business with. So that was one reason why we said that we need to have a solution which is very different. So hence, if ice cream is run with a focused management, with different agile strategies which are suited to its own distinctive business model, it can unlock more growth going forward.
Right. So if you could give us a sense, as delicious as the business idea and the potential and the product sound, it's a very tough business as well because supply chains, the capital that it requires for you to have a cold chain across the country, etc. If you could give us basic numbers on the ice cream business, it's about 2 to 3% of your revenue right now. What kind of EBITDA margins does it make? What kind of capital is invested in the ice cream business?
Yeah. So ice cream is roughly for us an 1,800 crore business. And it makes, if I look at last few years of margin, it makes low single-digit margin. This is a business now which is in investment phase. We are a national player. We supply ice cream across the length and breadth of the country. And when you do that, the overall cost of running the business is high, which is why a business like this gets a lot of benefit when it starts to scale up. Our business for the last 1 decade has grown in double digit. And going forward, given the headroom which is there to grow of penetration consumption, we expect this growth trajectory to get even stronger going forward. And which is why today when the business operates at a low single-digit margin on an average, we will get into an investment phase further. So margins will further go a little bit down. But from there onwards, as the operating leverage kicks in, we'll then start seeing acceleration of margin in times to come.
You spoke about low single-digit margins is what you see right now. And then after the investment phase, I think your listed peer does about 5 to 7%, if I'm not wrong. Is that where you would look to get at eventually, or do you think post-investment phase there is, scope to expand margins further beyond that?
When it comes to material margin, we make industry-leading margins. When it comes to total margin, when you add variable cost plus fixed cost, our margins are lower compared to the benchmark that you quoted. And the reason for that is because we are a national player, and hence our infrastructure is spread. As you start getting more amount of scale further in the business, you start getting operating leverage. So the second component today where we are, let me say, under index compared to market, we'll start getting that component also getting counted in terms of improvement in margin. And once that starts to kick in with further amount of growth and scale, we should be able to reach high single-digit margins.
And what happens to HUL's overall margins, because our ice cream is fairly margin dilutive? And what happens to HUL's own ROC? How much improvement do you see there?
Yeah. So ice cream overall is 3% of turnover. It's 1% of our profit. So there'll be small improvement in our ROC and margin after the demerger, but it is small and immaterial, I would say.
Right. And ice cream as a business, though you spoke about the large scope of growth that there is, it is still seasonal in nature.
Right.
And I think you have spoken in the past, and you've been one of the players that's spoken about how you're looking at de-seasonalizing the business. So how do we look at that? Because if an investor is looking to invest in a company, they would want to be able to reap profits or returns through the year. It cannot be in one season. So how are you looking at de-seasonalizing this?
Now, ice cream can be seen as a dessert, and hence it plays a role in the entire post-meal sweet category. It also has a role as a snacking category. And once you start looking at it a little differently like that, you start seeing that there are many occasions more where ice cream can be center of the plate. We keep seeing 100 to 200 BPS move. That keeps happening from season to non-season ice cream with every year of effort that we end up making. So roughly, I would say little less than half the business ends up happening during the peak of the season. And then the balance business is spread across the balance quarters in the year.
Do you have to pay a royalty to the Magnum ice cream? And
so today as HUL, we have a royalty contract, which is for all the categories that we deal with in Unilever. And once ice cream gets separated, our current contract runs till January 28. So we're going to pass on the royalty contract, which is all three components. It is component for the brand trademark. The brands that we have in India today, Quality Walls, Magnum, Cornetto, these brand trademarks are owned by Unilever. So the access and license to these trademarks will be passed on to Quality Walls India Limited under the same arrangement, existing arrangement that we have. After the demerger is completed in India, and once the global company gets also listed, and they might end up getting into a new relationship of royalty with them later point in time.
When do you expect this entire exercise to complete and shareholders of HUL to get Quality Walls shares in their demat account?
Yeah. We expect by end of this financial year, the business to get demerged and listed.
Right.
And start trading as well.
You believe it can double over the next 3 years or 4 years with better margins?
I hope it does.
Okay. Let's move on.
Let's move on then. Of course, coming to what everyone's been talking about when it comes to HUL, which is a change in management right now. I believe Priya Nair has taken over. It's been a couple of days.
It's been first week for her in the office.
Yeah. Yes, of course. So, a few, initial thoughts once Priya's come over. What's it been like? And also,
how's the vibe changed?
Yeah.
Let's put it that way.
Let's start off with that.
Yeah. So Priya is a homegrown talent. It's been 30 years. In fact, we celebrated her 30 years at HUL and Unilever this week. As Priya comes in, of course, she will have her own set of thinking and thoughts looking into the business. Priya, in last role, globally, she was president for the global beauty and well-being business. And that and we've spoken about it continuously, beauty well-being is an extremely important, strategically important category for us in India and segment for us. The expectation of growth from us for beauty well-being is much higher. And all that experience that Priya has in leading the global business will be extremely important for us as she starts to settle into the business.
This is also coming at a time when the consumer sentiment itself is at an inflection point. We are seeing acceleration in rural demand, and urban is also gradually picking up. So amidst all of this, with the new, wind beneath the sails of HUL or beneath the wings of HUL right now coming with new leadership, do you believe that the time is opportune for the company to grow a lot faster over the next 3 years than it has over the last 3 years?
Yeah. See, there are a few important parameters which determines overall consumption climate and FMCG growth. Number one is disposable income that consumers have. And number two is consumer sentiment. These both items are looking better overall as a country today compared to what it looked a year or 2 years before. So we have seen that the MAT trends, MAT trends are stable for FMCG. In the latest quarter, last quarter, we saw overall consumption demand, we saw an uptick. Rural now is growing ahead of urban. Both have improved. Urban is also improved. Rural is also improved, but rural is now growing ahead of urban. Put together, we see that overall macro conditions have improved, and we expect that this to sustain.
Well, with that, we call time on this edition of Trading Hour. That was the management of HUL, an exclusive conversation with Mangalam and Shilpa. By the way, just pull up Subros before we call time on the show. The numbers were just out a few minutes earlier. Revenues were up almost 9%. The margins saw a bit of a contraction on a year-on-year basis as well. The stock is now down almost 6% as we speak. Take a leave from Rima, Sonal and me. Thank you for watching. Halftime report on the other side.